Hi, it's Carrie with Flaherty Tax Resolution and Clover. So what happens if you don't file your tax return? So basically the IRS will, first they'll start sending you notices to say, hey, you didn't file your tax return, it needs to be filed. And then if you still don't refile, then they will look at your reported income as well as most likely your past history to determine if your return would have resulted in a refund or a balance due. If it results in a refund, they're just not going to do anything. They'd rather keep your money. I highly suggest you file that return within 3 years in order to get that refund. Now, however, if it would result in a tax balance due, they will file what is called a substitute for return. So essentially, all they're going to give you is your standard deduction and use all of the reported income that you have. So if you had any expenses, deductions, etc., you're not going to get those because they don't know what those were. So you're most likely going to have a much higher tax balance when they file a substitute for return than you would have if you would have filed the return on your own. Also, this is going to result in failure to file and failure to pay penalties. And then the interest starts accruing. So if this happens, you also always have the option to file your original return to replace that substitute for return that they filed. Now, if you do that, if you do file the original return, it will restart the 10-year collection statute that the IRS has. But in most cases, it's highly recommended still to do so because you'd much rather have a smaller tax balance lingering out there than a higher one, especially it'll affect the amount on the lien, etc. You can contact me to help resolve these issues for you. And then I'm also going to make an additional video for how this affects businesses for payroll tax returns and corporate returns. So follow me for more. Thank you.